good morning, and welcome to today's live technical analysis. We're going to be starting off with the euro against the dollar. So, what happened yesterday after we finished our live technical analysis? The Eurozone's CPI rate came in lower than expected, hinting at easing inflationary pressures on the Eurozone economy. Now, that may have weighed on the euro, given that the lower than expected CPI rates could potentially weaken the bank's resolve should they had wanted to hike or remained on pause. Therefore, the lower it goes, there are more chances of a pause or perhaps, in the extreme scenario, even a rate cut. Interestingly, the GDP rates for Q3 on quarter basis came in lower than expected as well. So you're essentially sacrificing economic growth in order to reduce inflation in the euro economy. Based on that, we're seeing that the euro is moving in a downwards fashion. So the dollar has strengthened or appreciated against the euro and is moving in a downwards fashion. Based on that, we would be maintaining a bearish outlook for the pair, given that it has also broken below our support level of 1.05650, which we had placed yesterday together. It is moving to validate our upwards moving trend line. So as we had noted yesterday, we had two upwards moving trend lines. In the event that this is broken, we would still maintain our bearish outlook, yet we would expect the pair to move towards RS2, which is now becoming S1. So given that this was support now to resistance, and note how beautifully the 4-hour candle touched on our support level on two occasions, and it actually opened just above our support level at 1.05650, validates this as a genuine support level, which was S1. This is now switched to a resistance, so R1. This is R2, and that would be R3 as we had noted yesterday, 1.06780 for R2, 1.0759 for R3. Now we could even slightly adjust our resistance level given that the move has already occurred, and a more accurate resistance level would be at the 1.0567 level. So this would be R1. We're keeping S1 and S2 as these are the next potential targets for the bears. But for a bearish outlook, it would need to break below our upwards moving trend line. If it fails to break above our upwards moving trend line, then we could see it move in a slightly sideways fashion, or it could even actually return to break above R1 and aim to test R2. For a bullish outlook, based on the events that unfolded yesterday, it would need to break above R2 and move towards R3. Simply breaking above R1 would not be sufficient. Breaking above R1 but failing to break above R2 could lead it to move in a sideways fashion. But for now, we're maintaining a bearish outlook for the pair, and we're going to be looking for our new support level for S3. And here we go. This could be our support level for S3. Let's see. This is between S2 and S3. 113 pips could be large enough, but we should note that the Fed's interest rate decision is due out later on today. So placing our S3 slightly further back from S2 provides us with a nice cushion in the event that the Fed takes the markets by surprise and decides to hike, or includes some extreme hawkish rhetoric in their forward guidance. 1.0310 would be my support level for S3. So market participants are widely anticipating the Fed to remain on pause. Personally, I think there is a possibility that they might actually hike by 25 basis points, or sounding slightly hawkish in their forward guidance, therefore potentially providing support for the greenback, which could lead to it breaking below S1 if the forward guidance is slightly hawkish. In the event that they do take the markets by surprise and hike by 25 basis points, I would not be surprised if it breaks below S1 and actually breaks below S2, if not actually moving towards S2 in the initial market reaction. On the other hand, should they sound predominantly dovish, we may see the pair breaking above R1 and actually moving towards R2. Narrowing of the Bollinger Bands, I think that will be up until the Fed's interest rate decision later on today. And we also have the ADP employment data and the JOLTS job openings figures, in addition to the ISM manufacturing PMI figures for the United States. I think, and most likely, the Fed's interest rate decision will overshadow all these events. But leading up to that moment, I think we could place some emphasis on the ISM manufacturing figure and the Jolstrobe openings. The ADP is expected to come in higher than the previous figure, and as such could provide some support for the dollar leading up to the Fed's interest rate decision. So for now, we're maintaining a bearish outlook on the euro, on the British pound, the dollar against the Japanese yen for another reason though, the Aussie against the dollar, and the dollar against the loonie, which is actually appreciating, potentially due to the weakening oil prices. But on the general, we're anticipating that the dollar may strengthen against its counterparts. We've placed our support and resistance levels for the pair. Also, the RSI is below 50, implying a bearish market sentiment. So we've essentially gone over the euro. We're going to be moving over to the British pound. So we're maintaining our sideways bias for the pair, and we have two options with the pound against the dollar. So you can see it's moving in slightly sideways fashion. RSI 50. I do expect the dollar to strengthen against the British pound as well. This could, as we said, be sideways moving channel. It would have to be retested again. And I think it's going to be moving slightly sideways, perhaps even in downward fashion, up until the Fed's interest rate decision. I'm not going to be changing our support and resistance levels simply due to the fact that the Fed's interest rate decision is due today. Therefore, potential for high market volatility. But in comparison to the euro, which has relatively closer support and resistance levels compared to the British pound, which is slightly wider between S1 and R1. For a bullish outlook, we would need to simply break above R1, and for a bearish outlook, simply breaking below S1. So up until the Fed's interest rate decision, perhaps in a sideways fashion. The Halifax house prices actually came in higher than expected, which is why we may be seeing some form of support for the British pound against the dollar, despite the dollar strengthening against the euro and the Aussie, I'm assuming, weakening slightly against the Aussie. Surprising given the Kaijing PMI figures that came in earlier on today, manufacturing PMI. And against the Aussie, it is appreciating. Let's check gold. Slightly up on the daily, downwards fashion. So we're seeing a slight strengthening of the US dollar. So for the British pound, I think we've gone over it. Essentially, we're anticipating the Fed's interest rate decision one more time. Halifax house prices higher than expected, potentially providing support for the British pound. Now, the dollar against the Japanese yen, I would be maintaining a bearish outlook for the pair. And despite the Fed actually, in my opinion, potentially hiking, under that scenario, that could result in the dollar gaining against the Japanese yen. However, government officials have stated that they are preparing to intervene in the FX markets. As we had noted last time, it could be reaching levels where they decide enough is enough and may actually intervene in the market. Therefore, despite on a technical basis, the indicator supporting an upwards fashion, so a bullish momentum, from a fundamental point of view, I would be maintaining a bearish outlook. Even if the Fed does hike, I think we may see a government intervention by the BOJ, by the government, which could tell or instruct the BOJ to intervene in the markets. Therefore, bearish outlook for the Japanese yen against the, for the US dollar against the Japanese yen, bearish outlook, so strengthening of the Japanese yen. We're going to be keeping our support and resistance levels as we had placed them together yesterday. As they continue to be validated, just adjusted slightly RR1, 151.65, slightly more valid. We're going to be checking oil prices as well. Oil prices broke above our support level of 81.70. So this could have been resistant support and resistance, which is now resistance and support. Note how the 4-hour candles closed and opened exactly on 81.70 on using the 4-hour time frame, validating this as support level. So I would maintain a bullish outlook on oil for the rest of the day from a shorter time period. Perhaps moving to the mid-range, moving slightly sideways, or even breaking above R1, although that appears to be unlikely at this point in time. Note the RSI indicator is slowly moving towards 50, implying that the bears may be losing momentum in the oil markets, particularly crude oil, WTI cash. So perhaps for the day, bullish outlook on oil. From a more macro perspective, bearish outlook despite breaking above S1. It would need to break below. It would need to break above R1 for it to switch to a bullish outlook from a more macro view. So this could be a temporary market correction to higher ground before moving lower. But as we said for the day, maintaining a bullish outlook on oil, um, which is actually probably why we're seeing some resistance by the Canadian dollar. Given that Canada is a major oil exporter, if the prices of oil are moving in upwards fashion, it could make sense that the loonie would be appreciating, but it appears that the dollar may be countering that potential strength. It's above, it's actually above R1, 1.3885. Note the three, could even say four candles, uh, roughly three candles fluctuating around R1, validating it as a potential resistance level, which now appears to have turned to support. We just have to slightly, let's just slightly adjust our R1. It's currently testing R1 with the new correction that we placed. For a bullish outlook, it would need to break above R1 and move towards R2. So are we keeping R1 where it's meeting resistance at this point in time? So for a bullish outlook, we would need to break above R2. But it appears that there is some resistance at this point. Therefore, validating this as potential R1, despite it potentially being broken as we're talking at this point in time. S1, 1.3785, S2, 1.370, S3, 1.360. We could place a second upwards moving trend line, so maintaining a bullish outlook for the pair, despite the temporary increase in oil prices. Aussie, so as we said before, China's Caixin manufacturing PMI figures, preliminary figures, came in lower than expected. Now, this may be concerning, and we also know Australia's trade balance tomorrow, which could actually impact the pair. But based on what we're seeing from China, if your manufacturing industry is declining and, as a matter of fact, actually contracting since it's below the figure of 50, this might be concerning for Aussie traders. Why? We've said this numerous times. Australia is heavily dependent on China for its exports. The deal with the EU appears to have broken down, as was reported by Politico. Therefore, the chances for Australia to diversify their exports by increasing perhaps the EU, that deal appears to have been thrown out the window for now. So they're still reliant heavily on China, whereas were they equally balanced, let's say, between China or India and the EU, perhaps any financial releases stemming from China may have been slightly muted or not as impactful on the Aussie. But at least for now, I would be maintaining a bearish outlook for two reasons. One, China's lower than expected manufacturing PMI figures, which is worrying for the Chinese economy. And two, I personally think that the Fed may actually hike or include some hawkish rhetoric in their forward guidance later on today. So, for those two reasons, even if it is moving in a sideways fashion, staying between the sideways moving channel that was incepted on the 3rd of September, based on what we're seeing today, I think it may move in a downwards fashion. If it does not, staying between S1 and R1, RSI near 50, so neutral outlook, potential. It could move in a sideways fashion, but based on what I said before, I think it would actually move towards lower ground on a more macro level. Gold. Now, know how beautifully it touched the wick slightly broke above the 2005 resistance level. Slightly sideways, it's dropped below the mid-range of the Bollinger Bands, and since we're expecting the dollar to appreciate, that would make sense that we would expect the precious metal to move towards lower ground, breaking below S1. Note the candle, this actually swing low that touched exactly on 100 1975. This could actually form into a bearish candle, or it could potentially, see if we can actually draw, this could actually move towards the mid-range of the Bollinger Bands before actually moving back down. So it could move slightly higher, testing the mid-range, breaking below S1, moving towards S2. If the Fed does hike, then breaking immediately below S1 and moving towards S2 for a bearish outlook. Whereas if I'm wrong, breaking above R1 and moving towards R2 would constitute for a bullish outlook. Note that the R2 is significantly larger in terms of a distance between R1, so simply breaking above R1 would constitute as a bullish outlook. RSI near 50, so perhaps neutral market sentiment leading up to the Fed's interest rate decision. We're looking at oil as well. As we said before, appears to have broken above, but since this has not formed yet, so it's not closed, it's currently being formed now. This could either be a breaking above support, resistance to support, or it could be a validation of support and resistance at this level. We could even actually just color this as a gray area, as we are unsure as where it will move. It depends on where the 4-hour candle will close. If it closes below, this is resistance. If it closes above, this is support. So only time will tell. In the event that it closes below the 81.70 figure, we're going to be placing a potential S3, as this would become S1 and then S2. 70.60 would be my S3 in the event that the 4-hour candle closes below the 81.70 level. So personally, it would depend on where this 4-hour candle closes. So I would be interested in how oil moves for the rest of the day. We could be also looking today at, what could we look at? We could look at Apple, Intel, Google, Airbus, Baba, Facebook. Facebook might be interesting considering that the lawsuit against Meta uh, appears to be actually continuing. So I've forgotten since when the last time was when we looked at the chart for Facebook or Meta, whatever you'd like to call it. So you have, I actually broke below S1, validated S2 at 280 using the wick of this bearish candle, opened above, second candle validating support at 295, still below the mid range. And with the lawsuit continuing, I would not be surprised if the stock price moves towards lower ground. It appears that this gap was filled by this wick. This was also filled by this bearish wick. So there's no breakaway gaps, but I would be maintaining a bearish outlook for the company's stock price. Let's look at Tesla, bouncing off S1 at 193.10. RSI moving towards 30. So it appears that it was indeed overbought, perhaps gaining some trajectory. If it breaks above the mid-range of the Bollinger Bands, I would switch to bullish outlook, as it could be reaching to fill this breakaway gap that was formed on the 18th of last month. So that would be interesting to see. But I do not think it would break R2 at this point in time. I think it may just simply seek to fill this gap or test around the 231.40 level before moving lower once again. From a technical point of view, since it's below 30, it appears to still have some bearish tendencies, but it would not be surprising if it simply comes to test this gap here. So keeping a close eye on Tesla as well. We can look at Apple, Ford, or Amazon. Amazon appears to be supported by our 169.0 support level. it appears that our support and resistance levels are still holding and therefore valid. What are we going to look at now? We can look at Amazon. I'm going to clear the chart and let's place this together. And let's move these to the side. So we have, let's note the gaps first. Let's take this rectangle, breakaway gap, and then this may have been filled. Let's see. Continuation gap, perhaps. I'll actually see. So support could be at around, I usually take the bodies of the candle, so right around here. And I'm actually going to stick to my methodology. I was considering taking actually, let me just show this for a second. These two wicks by combining this bearish candles, so they're opening figures, but using the most recent data, my support level would be at the 131.25 level. And 31.25 for S1. Then S2, I'd bring could be there. Now, usually I may have taken this point here, more recent, validated by this wick. However, given that this is a gap that may be filled in the future, most likely, or at least the price action may come back down to test and then move in an upwards direction. I would be placing my support level of S2 at around this point. On 24.85 and then S3 at the end, 118.07. We put it at 05. 05 is rounded up as well, so that could be valid as well. So 118.05. Now looking for resistance at R1 on 34.57, 55. BR1. And 34.55 for R1 and then for R2. Now, I'm taking this as R1. It does coincide with the upper range of the Bollinger Bands, but that right now wasn't on purpose. I'm taking the closing of this bearish candle because at this point, a gap was formed. Just like here, there was a gap. And let's just actually put that in so that you can visualize this yourselves. At this point, a gap was formed, as you can see by the wick, and then it was filled later on. I do think that will be the case with the gap that was formed around here. So this is why we are pointing out the gaps that exist. At this point, there was heavy selling pressure, which caused the price action to jump or essentially open at a much lower level, forming this aka gap. Therefore, I personally anticipate that at this point there is heavy selling pressure. Therefore, if it does reach S1 at 134.55, it may meet significant resistance. Let's see. Let's see what we can use. No. Let's see. Distribution. And then is there heavy selling volume here? Downwards. Look, based on a technical level, aiming for R1, perhaps moving for R2. We've mentioned why we believe this is a valid resistance level. Deleting that indicator, let's keep to the other side. Above 50 implying a slight bullish market sentiment coinciding with the upper range of the Bollinger Bands. Then for R2, somewhere around this opening of this bearish candle may have been desirable, but it may be slightly larger. We'll keep it at this 142.15 for R2. And then for R3, taking this swing high, might be slightly close actually to R2, so we could actually bring this down, coinciding with the opening and the wick. It's a bit close, but nonetheless could still be considered valid. 138.80. And then 144.65 for our resistance level at R3. So we're maintaining a bullish outlook for the company's stock price. Yet, given that, from my own personal opinion, if they do hike, then it would move in a downwards fashion. Why? If the greenback strengthens, then usually the US equities markets move in a downwards fashion as US equities become more expensive for overseas investors. Therefore, there is potential for reduced demand for US stocks, which could actually push the price lower. However, if I am wrong, and as is expected by the majority of market participants, that the Fed will remain on pause, we may see the stock price moving in an upwards fashion. And let's just see perhaps one or two more. Let's look at the Nasdaq 100. Heavy buying pressure at this point. 1,400, 14,245. It's actually close to our one, so very tight support and resistance levels. That's 2, 13,920 for S2, and then 13,580 for S3. Then we have R1, 14,430. R2, 14,790. And lastly, we have R3, 15,225. Now, if the Fed remains on pause, potentially moving in upwards fashion, RSI breaking above 50 may imply switch from a bearish to a bullish market sentiment. Whereas should the Fed hike, breaking below S1, moving towards S2, and could actually move towards S3. But from a technical point of view, perhaps remaining confined between the very tight support and resistance levels. So any break that could be considered. Actually, let's just bring R2 slightly lower. 14,730, and then I actually need to fix R3 using these candles here. 15,120. Okay, that's better. Since the S1 and R1 are very close together, for a bullish outlook, it would need to break above R2, and for a bearish outlook, it would need to break below S2. Simply breaking above or below S1 or R1 doesn't give much significance, as could be a small peak, could even be a wick, market correction, perhaps higher, taking on some stops before moving in either direction. And with that, that does it for the day. Thank you, and I'll see you tomorrow. Bye bye.
Let's go ahead and get started. Okay, so I'm Melanie and I will be your speaker for today's webinar. So for today's session, we're talking about the second part of our Build Your Trading Strategy series. So today we're going to be focusing on day trading. Okay. Yeah, if you guys have any questions throughout the webinar, feel free to let me know in the chat. Yeah, I think that's about it. So before we get started, as per usual, a risk warning. So our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So as per usual, I'm Melanie and I'm your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. So I'm just going to show you guys what are the key news events to look out for, or how you can implement them into your strategy. So this is based off of last week's news events, but I will show you guys this week's news events as well. I'm just going to use last week's as an example. Then we'll reference higher time frames, see which time frame you should use for day trading, identify momentum, taking a trade, and we'll go through a couple of basic day trading techniques. Okay, so let me know in the chat how many of you guys like to use or like to day trade. And yeah, let's just go ahead and get started. So this was last week's events. Okay, maybe I'll just make my camera smaller. Okay. So this was last week's events. You can see we like to use forexfactory.com. So let me just pull out this week's events. So this just shows you the medium to high impact news events. This is just how we like to use an economic calendar by comparing the actual and forecasted data to determine the outlook of the news release. So if you take a look at my screen now, right? When you go into forexfactory.com, it will give you guys, I mean, it kind of looks like this. So it'll give you all of the impact, all of the different impacts events, as well as today's events. But let's say if I'm looking at this week's events, so 23rd to 27th, you can see I have all of the events, and I like to click this filter. So as I mentioned earlier, we like to just look at the medium and high impact events. But if you are particularly looking at a specific currency or different event types, you can go ahead and adjust those as well. Okay, and then you can take a look and see all of the different events that will take place this week. So it's quite a busy week this week with a lot of events taking place. Yeah, a lot of PMI releases. Okay, so let's just get back to our slides. So it's important to use an economic calendar when you day trade, because day trading in particular, it will affect your trades. Whenever a news release is out, you could see it go up or down. So it's important to take note of your fundamentals when you are day trading. Okay, next, let's move on. So now we are referencing the higher time frame. So what we mean by this, okay, let me just pull out my charts to show you guys. Okay, so let's say if I'm looking at the Aussie dollar, okay, and I'm looking at it on the 4-hour time frame. Okay, so let's say if I want to um analyze this on the 4-hour time frame, I will go in with all of my trend lines, all of my the Fibonacci, so on and so forth. But I will also want to reference the higher time frames, such as the 1 day as well as the 1 week. Okay, so there's actually the reason for this is so that you can see what the general trend is. Okay, even on the higher time frames, because sometimes it does differ from between the time frames. So it's important to take a note of the different time frames, especially the higher time frames. And there is a strategy. I don't know, can't remember right now who it's by, but it's like a factor of 4 or 6 or multiple of 4 or 6. In this case, since we are referencing higher time frames, the rule is that you will go up either by a multiple of 4 or by a multiple of 6. So 4 times 6 would be 24 hours. So then we will look at the daily time frame. And then the daily time frame times 6 is 6 days, but we don't have 6 days on TradingView. Closest will be 1 week. So that's why we look at the 1 week time frame. Okay, that's basically how it works. If you're looking at a smaller time frame, so for day trading, normally we look at higher time frames. But if you want to look at the lower time frames as well, it's the same concept. Instead of a multiple, you look at a factor of 4 or 6. Okay, I can't really remember who started this strategy, but it's quite a popular one to go by. Okay, so that's what we mean. So which time frame should you use for day trading? So before we get into that, okay, day trading, normally we use either the 1 hour, 4-hour daily time frames, depending on your preference, and also depending on which time frame gives you a clearer market structure. So this is an example of a clear market structure. Okay, this is excuse me, this is an example of an unclear market structure. Okay, you can see the markets are really choppy, and you can't really see the shape of the chart very clearly. Okay, so obviously, if you are looking at which time frame is the most important? If we're looking at the same chart, okay, this is on the M15, and you can see that it's really unclear. Okay, and this is on the 1 hour view, which is clear. Okay, so what I'm trying to highlight here is that it really depends on which time frame gives you the clearest shape or chart. Okay, and this is really important for so when you look for swing highs, swing lows, this is really important for your support and resistance levels, which obviously is important for your entry, your stop loss, and take profit levels, but it's also important for your analysis. So your Fibonacci trend lines would have to follow the shape of your chart. So the clearer it is, the more effective your Fibonacci will be. There's also graphical tools. So like you saw over here, I have a really nice descending trend line with a very clear market structure. Okay, and this is also part of graphical analysis. So it shows you the trend really clearly as well. So at the very basics, the clearer the swing low or swing high, and the clearer the trend between these 2 points, the more accurate your analysis will be. So apart from having your own preference on which time frames you like to use as a day trader, it's also important to take note of which time frame gives you the clearest market structure. Okay, so far, are there any questions? Okay, if all good, let's move on. Okay, so here's just a brief intro into multiple time frame analysis, since we are briefly talking a bit about time frames. So the multi-time frame analysis. Okay, thanks, Ben. So the multi-time frame analysis is a trading strategy that involves analyzing the market from multiple time frames, like I mentioned earlier. So this, as a beginner trader or even as an expert trader, it basically helps you to get a better understanding of the market and make more informed trading decisions. So the first step in this strategy is to select the timeframes to analyze. So typically traders will choose at least 2 timeframes. So there'll be a short-term time frame, so 15 minutes, and a longer time frame, which will be either 1 hour or daily. Okay, so the short-term time frame is used to identify the most recent trends and price movements, while the longer-term time frame is used to identify the overall trend and market direction. Okay, so I briefly went through all of these earlier when I showed you guys the chart. Okay, but yeah, so once the time frames are selected, you can then analyze the markets from each time frame. Look for key support and resistance levels, the different trends, as well as patterns. So for example, if the short-term trend is bullish and the longer-term trend is also bullish, this could indicate a strong uptrend in the market. Okay, so as a trader, you can use this information to make more informed trading decisions. So if the short-term trend is bearish, on the other hand, because in this case we're talking about bullish. So on the other hand, of course, if your short-term trend is bearish, longer-term trend is also bearish, of course, you can probably expect it to be a strong downtrend in the market. Okay, but if let's say the short-term trend is bullish and the long-term trend is bearish, then you can make use of your different indicators and graphical analysis tools to help you to forecast where markets are headed. So it's a little bit more complicated for those. Okay, so overall, multi-time frame analysis can help you as a trader gain a better understanding of the market and make more informed decisions by looking at the bigger picture and analyzing trends and patterns from the different time frames. Okay, so what should you look out for on higher time frames? Firstly, we have the key graphical levels. So these, we're talking about support, resistance levels. Next, we are talking about trend lines, trend channels, which obviously give you an idea of the trend. Next, breakouts. So by breakouts, we're talking about either breaking out the trend line, breaking out of trend channels, or different key graphical levels. Big moving averages. So if you make use of the 50, 100, 200 golden cross or death cross levels, the indicators, and Ichimoku cloud as well. So we can use the Ichimoku cloud to give us an idea of where prices are headed towards. So if price is moving below the Ichimoku cloud, it is a bearish signal. If price is moving above the Ichimoku cloud, then it's a bullish signal. Okay. Okay, so next we have big Fibonacci levels like retracements, extensions, and projections. And lastly, we have price action. So what we mean by price action is basically looking at past, present, future momentums from the previous bar to dictate your strategy. Okay, so let's take a look at how we can identify momentum. Okay, okay. So firstly, let's look at the different momentum indicators. So the first one we're going to be talking about is the MACD, or moving average convergence divergence indicator. So I personally really like to use this indicator because at one glance it tells you exactly what the signals are. Okay, so it's, if you want to know the calculation behind it, it's basically works by calculating by subtracting the 26 period exponential moving average, or EMA, from the 12 period EMA. So the signal line is a 9 period EMA of the MACD line. So MACD is best used for daily periods where the traditional settings of 26, 12, and 9 days is the norm. MACD triggers technical signals when the MACD line crosses above the sell line, the signal line, which would then signal that you can go in for a buy, or falls below it, which is a signal for sell. Okay, so this uses three exponential moving averages to identify price movements. Difference between these averages is shown in a histogram. I'll show you guys in a little bit. And the movement can show whether a trend is strengthening or weakening. However, moving averages always lag behind price action, and they are more suitable for identifying entry points. So here is the points that I was talking about earlier. You can see the MACD line is the blue line, signal line is the orange line, and histogram is the red and green areas. And of course, the zero line is just over here. Okay. So the selling signal occurs when the MACD crosses over the signal line, or if you can see over here, it's also when our histogram is red. Okay, and yeah, so this is one of the trading strategies. So over here we have a buy entry. Okay, we're showing you the different buy entries that you can identify from the MACD. So you see price, or rather the signal line crossing over, and you also see this MACD histogram being green. So it's a huge bullish signal. And then once it crosses over again, it is a bullish signal here again. Crosses over, bullish signal, crosses over, bullish signal. You guys kind of get it. Okay, so every time there is a crossover, you can expect a change in trend. Okay, so if we look at the sell entry, same concept. Okay, it's just that when the signal line crosses over, then you see this red area. Similarly over here and here as well. Yeah, you guys kind of get it. Okay, but as I mentioned earlier, it is a lagging indicator like you see over here. So over here it says it's pretty green, and it doesn't cross over until after this drop. Okay, so just be careful or just be aware of that if you are intending to use this. Okay, next, let's move on to a couple more momentum indicators. So I also personally like to use these two. Okay, RSI, let's start with that. So how it works is it oscillates between 0 and 100, with values above 70 considered overbought, values below 30 considered oversold. When the RSI value is above 70, it suggests that the security may be overvalued due for a price correction, potentially indicating a sell signal. When the RSI value is below 30, it suggests that the security may be undervalued and due for price rebound, potentially indicating a buy signal. Okay, I guess I'll show you guys an example. Okay, there's an example in the next slide. Okay, so stochastic oscillator readings more than 80 indicate that price is near its high. Readings below 20 indicate that prices are near the lows. A security is overbought when the percentage K line moves below above 80 and is oversold when the K line moves below 20. So this is an example here. In this case, we like to use hidden support and resistance levels. So for both of these indicators, in this example, we use stochastic, but you can also use this method for RSI as well. So for this method, you see that on our stochastic or RSI indicator, we have a hidden resistance level. Basically, all of the peaks are at the same level here. But you can see that on our price chart, price is making a higher high. Over here as well, a higher high. Okay, so what this basically means is that we can expect price to drop immediately after this, which is exactly what happened here. So once you identify these and once you identify price making a higher high on the second peak, whereas on our stochastic or RSI, it's giving us the same peak or the same level, then you can expect price to immediately drop after that. Similarly for over here. And in this example, we're also using stochastic, but here we are using a hidden support level. So you can see we have this really nice support level on our stochastic. But you can see on our price chart, price is near lower low. And over here, we have an ascending trend line. Whereas, of course, over here, we don't. So this suggests that we can expect price to continue to drop or continue to rise from the buy entry, or rather from our ascending trend line to the take profit. Okay, and you can see that's exactly what happened here. Okay. Okay, so if we look at bearish divergence on the other hand, Here we have price. Is this okay? So you see a descending. It's quite subtle, but you can see price is making lower highs on our RSI, whereas on our price chart, it's making it's still a resistance level. Okay, so price is testing a key horizontal resistance level with price making a smaller high, resulting in bearish divergence with RSI. So bearish divergence, basically when it's RSI or stochastic, you see price making a descending trend line. Whereas on our price chart, it's kind of staying at the same level. That's basically what bearish divergence means. Okay, so our descending resistance line on RSI caught the past two reversals correctly over here. So you see there's two drops here. So we can expect that the third one, we would be seeing another reversal over here. Okay, next, yeah, so this is just the example from here. You can see that price reverses strongly because of the horizontal resistance here, as well as the RSI resistance and bearish divergence. Okay, another example here, but this one is just on a smaller scale. So you can see that even if the difference in price is pretty small, it can also work. So for stochastic, it's giving us a lower high, and on the price chart, it's making a higher high. Okay, so yeah, so we can expect price to continue to drop. Okay, so you see the repeated pattern here, bearish divergence here and here. You see price drop here immediately after that. Okay, so it rises, and we see this price making a higher high once again, but on our stochastic, it's making a lower high. So we can expect price to continue to drop, or rather, not continue to drop, but you can expect price to reverse from this point. Okay, and that's exactly what I did here. Hey, so divergence potential. So over here, we see price making a higher high, and on our RSI, price is making a lower high. So same thing, this is another example of a bearish divergence. First point, we want to always take note of where the bearish divergence started, as this is the level where it would tend to reverse to. Bearish divergence means price is making higher highs, RSI is making lower highs. Okay, so we can expect price to drop down here. And because this is so if you were here for the support and resistance webinars, you would know that this is called a overlap, um, overlap support. Basically, it's just when price respects the bulls and bears of this level here. So we basically have swing highs and swing lows that are touching the same level. That's just what an overlap level is. So then you can expect price to come back down and reverse off of it again, or react off of it. So you see here, it's a overlap support because we have swing highs and swing lows. You can see price did reverse off of it. Okay, forecasting breakouts. So we have this ascending trend line on our price chart, but we also have this ascending trend line on our RSI. But at this point, at this first column, price actually RSI broke out of the ascending support line before price did. So this forecast that price might actually break out of it after this level here, which is exactly what happened here. Price broke. This is basically a predictor that like price is likely to break out of this ascending trend line. Okay. So here as well, in this case, we have an ascending trend line or descending trend line, but we are expecting price to break out of it and head upwards. So price is moving downwards here. This is actually not a valid trend line because you guys will know that a valid trend line requires 3 significant touches, whereas here we only have 2. But on our RSI, we do have 3, and that's why we're pointing it out. Okay, so we have 3 points making a valid trend line, and price RSI is breaking out of this descending trend line. Okay, so from here, price is breaking out of it, so we're expecting it to continue to rise. We're expecting this price to continue to rise and break out of this ascending trend line. Now we see over here that there is also bullish divergence. Bullish divergence is basically the opposite of bearish divergence. So on our price chart, price is making a lower low, and on our RSI, it's making a higher low. Okay, so first point, price is now testing the descending resistance line, which is basically a descending trend line, and we're wondering if it will break out of it. But we see RSI descending line breakout over here right before this. And number 3, the recent bullish divergence further suggests that we could be seeing a strong reversal or breakout of this descending trend line. Okay. So we have a successful breakout of the descending resistance line as forecasted by our RSI. Okay, any questions? Okay, that's great. Let's continue. So lastly, is this our last part? Okay, I'm not sure if this is our last part. But okay, next we are taking the trade. So firstly, if we look at the different news events, so bringing us back to our first point where I mentioned that when you're day trading, it's really important to look at your fundamentals and take a look at your economic calendars. So in this example, we are using the US unemployment claims, which occur 12:30 p.m. GMT every Thursday. We also have the central bank interest rate decisions. Okay, so in this example, on the 15th of June, we had the unemployment claims, which was over here. You can see Thursday, 15th June at 12 o'clock, we can see this drop over here. Okay, because of the unemployment claims data. Okay, and this is on our DXY. So we see this drop. If we recap, go back to what we talked about for the MACD, you can see price cross over here, right? The signal line and the MACD line, price crossed over. And then we also see this red histogram, the red area. So very bullish signals, and you see price drop at that timing. But if we look at gold, you see here XAU USD, this is gold. And you can see that on the other hand, on the same day, at the same time, gold actually shot up. Okay, you can see if we're looking at our MACD, price signal line cross over the MACD line. Okay, and also it's giving us a green histogram area. So very bullish signals, and you see price shoot up at the same time. Okay, so this is just because gold tends to be negatively correlated to the DXY. tends to be, not always, but yeah. So that's why it's important to keep up with your fundamentals and take a look at these as well. So if maybe I'll just sidetrack a little bit and show you guys this correlation table from my FX book. Okay, so you can type in, so I think normally we use 80%. So if it's on negative 80, so currencies with correlation lower than 80% and higher than 80%. Okay, we're day trading, so I'll just use 1 day. Okay, I can't remember if it's 80 or 70%. If you guys know, let me know in the comments in the chat. But yeah, so it highlights those that are really strongly negatively correlated or positively correlated so that you can check them on your charts. So if you can see one that is really strongly, maybe like this 90%, the Euro AUD as well as the AUD franc are pretty strongly negatively correlated. So you can expect when price goes up on one, the other will go down. Okay, yeah, it's just a bit of a sidetrack for you guys to take note. Or if you guys are curious. Okay, let's get back to our slides. Okay, so another example here is the FOMC meetings. So just now, I think I mentioned we're talking about central bank minutes. So central bank minutes for FOMC meetings often come with your interest rate increases, interest rate hikes, or even if they stay the same, those tend to be released during FOMC meetings. So you can see on the 14th of June at 6 p.m., at that time, you can see MACD line and signal line crossing over each other and giving us a bullish signal. You can see price also shot up. Okay. Oh, yes, this is the DXY. So because I mentioned earlier that they tend to be negatively correlated, you can expect price to drop down for our gold at the same time. Okay. And you can see here that it is a little bit laggy because the drop really happened a little bit earlier, but our MACD was only able to catch it a bit later. So just take note of that if you intend to use the MACD. But otherwise, you can see that it's pretty useful in helping you to catch any changes in trends, which tend to be quite frequent because the market is pretty volatile during news releases and during events, which is why it's important to keep up with your fundamentals or look at your economic calendar. Okay. Again, another example, 12th of October, we have the unemployment claims. Once again, can see price shoot up at 12:30 p.m. for our DXY. So you can probably expect it to drop as well on our Euro US for our gold. But in this case, we are talking about Euro USD, and price is dropping as well. Okay. Basic day trading techniques. Okay, so we kind of went through a few of these already. Okay, but yeah, we'll just talk about them a little bit. So basic day trading techniques, we have the first one, which is following the trend. So anyone who follows the trend will buy when prices are rising or short sell when they drop, which is normally what we recommend, to just follow the trend. And that's why it's important to look at the different time frames as well. But this is done on the assumption that prices that have been rising or falling steadily will continue to do so. Contrarian investing. This strategy assumes a rise in prices will reverse and drop. The contrarian buys during a fall or short sells during a rise with the express expectation that the trend will change. So you can see why we typically recommend the first technique. Okay, Trading the news. We also highly recommend trading the news because investors using this strategy will buy when good news is announced or short sell when there's bad news. And this is really closely linked to investor sentiment as well, which of course can affect the market's volatility as well, but can also lead to higher profits or higher losses. Okay, that's all for our slides, but we still have a little bit of time. So let me know in the chat if there are any charts that you guys would like me to go through. I think we maybe have time for one or two. Maybe we will just take a look at gold first. Okay, and then if you guys have any requests, just let me know in the chat. Okay, so if I'm day trading on the 4-hour time frame, right, I would look at the of 1 hour time frame maybe. I mentioned earlier the higher time frames I would look at would be the 4-hour and daily time frames, okay? Because factor of 4, factor of 6, or multiple, sorry. Okay, so let's take a look at our daily time frame. Okay, on our daily time frame, we have this multiple swing high here. Okay, we also have this ascending trend line. And you can see prices are pretty bullish over here on our daily time frame. Now on our 4-hour time frame, you can also see prices are really bullish. Okay. But there is a resistance level here. Okay. That price is currently testing. Now our 1-hour time frame. So this is where I'm gonna go in and do our analysis. Okay, so I'm just gonna place my first support here. Second support here. Oh, first resistance. Second resistance here. Okay, second support here. So these are just purely graphical. And then now I'll go in with some Fibonacci levels to support my graphical levels. Okay, and I can see my 23.6 lines up with my second support. Okay. Okay, I'm looking for a retracement. So for retracement, we use these 5 levels. Okay, and I can see my 50% lines up with my first resistance. Okay, my 78.6 also lines up with my second resistance. Okay. Okay, my second resistance is a pretty significant level. Okay, you can see I can pull it all the way back. Okay, I'm just gonna highlight this area here. Okay. Okay, now I'm gonna go in with some indicators. So I like to use Ichimoku and MACD because at first glance it tells you exactly what the signals are. So MACD you can, or rather Ichimoku, you can see price moving below the cloud. Okay, let me see if I can zoom it in. Yeah. So you can see price moving below the cloud, and on our MACD, can kind of see price moving below, or rather price crossing over already as well. Okay, so overall bearish for both of these signals. So I can go in for a sell from my first resistance to my first support. But I'm gonna go in just to double check. I'm gonna go in with another indicator as well. Okay. So it's really important to have a bunch of indicators that you're really comfortable using because there are so many indicators out there. So a bunch will tell you that it's bearish, and then the other half will tell you that it's bullish. So as long as you know how to use a few indicators, and then you just test them whenever you are done with your analysis, your graphical and your Fibonacci analysis, that would be enough. Okay, so I can see my RSI, I have a descending trend line as well. So very bearish over here. So I'm going in for sell from my first resistance to my first support. Okay. Um. Okay, we have a request for US oil. So I'll just go ahead and do that now. Okay. Let's see on the 4 hour or 1 hour time frame, which of these gives us a clearer graph, here, clearer chart. Yeah, I think the 4 hour gives us a clearer chart. Yeah, let's go ahead and do that. So starting with our weekly time frame. Okay, trend is pretty bullish. Okay, except for this reversal here. Daily also, is this a trend line? Okay, no trend line, but also pretty bullish. Okay, in just the trend, but just if we just look at the trend alone. Okay, but here is pretty bearish. Okay, let's see if we have any trend lines. Okay, we do. We have this ascending trend line. Okay, but it's currently testing this trend line. So we'll go ahead and take a look at that in a bit. This is my first support. And my second support, maybe this here. Here. Okay, and then my first resistance and my second resistance just here. Okay, now let's go in with our Fibonacci levels again. Okay, I have this 61.8 that lines up with my second resistance. And my 61.8 also lines up nicely. Then I'm looking for another retracement, and I can see my 60. Okay, my 50% lines up with my first resistance. And here, my 61.8 also lines up with my second resistance. Okay, now let's go ahead and look at some indicators. So same thing. Price is moving below the Ichimoku cloud, so it's giving us a bearish signal. MACD is also giving us a bearish signal. Let's see RSI. Okay, RSI isn't really telling us much. Let's look at stochastic. Okay, stochastic, you guys can see this hidden resistance that we talked about earlier. Okay, and we see that price has made a lower low here. Okay, so this means that we can continue to expect price to continue to drop. Okay. Okay, maybe we can look at another indicator. We see price crossing over each other. Okay, price is moving below the EMA and SMA, so it's a bearish signal. I thought we could see a trend difference if there is a crossover, but the trend difference has already occurred. Okay, so overall, all of our signals are pretty bearish despite this ascending trend line. Okay, so we can expect it to continue to drop or to break out of this ascending trend line. I'm going to remove that so it's not so messy. To drop and continue to drop towards our second support. Okay, but I want to mention that we might see price reacting off of this level at our first support because we have a confluence area here with the swing lows and also with the 61.8 and the 100% Fibonacci projections. Okay, so we might see price reacting off of our first support. But overall, there's still a lot of downward pressure. So we can probably expect it to break out the first support and head towards our second support. Okay, and that's it. Yeah, let me know if you guys have any questions. If not, that's all the time we have for today. Thank you guys so much and have a great rest of your week. And I'll see you guys next week. Bye everyone. Bye, Yuria. Thanks for coming. See you next week.
Hello, welcome to another of one of our helpful videos. Today, we'll be taking a look at what a call option is. Also known as a high option, a call option is a financial contract between two parties to which the buyer is given the right but not the obligation to purchase a financial instrument or stock from a call option seller at a set price on or before a specific date. The instrument is called the underlying asset. When the price of the underlying asset increases, you will see a profit. The cost of buying the call option is called the premium. The premium acts like your insurance against the large loss. This is because the sum you pay for the option is the maximum amount you can stand to lose on that option. The last day the option contract is valid is called the expiration date or time to maturity. It is the date by which you'll need to exercise your right to buy the asset. If you don't, the option loses its value and you essentially forfeit the premium you paid. The set price is also called the strike price. It's the fee the seller agrees to sell the asset for on or before the expiration date of the contract. So, why does someone typically buy call options? Well, call options are usually purchased to make a profit on stock. They're also considered low risk because the most that you can lose is the premium you paid. But as always, be cautious when trading and understand all the risks that come with it. Thank you for watching.